Hi everyone, welcome to the second part of the lecture on taxation. Last time we left off at the effect of a labor tax on labor supply. We decomposed the effect of a labor tax into two effects. The substitution effect first makes leisure relatively more valuable than consumption. So leisure increases and consumption decreases as a result of that effect. The income effect on the other side makes the agent poorer overall. So not only his consumption is going to decrease, but his leisure will also decrease. A decrease in leisure means an increase in hours worked. The final effect is unambiguous on consumption. Consumption decreases both through the substitution effect and through the income effect. However, the net effect on labor supply is uncertain. It all depends on the relative strength of substitution versus income effect, and that will depend on preferences. So that will depend on the shape of the utility function. Finally, we looked at the impact of a labor tax on those who do not work. Well, those who do not work do not have any more incentives to start working because the new wage due to the labor tax is now lower than the former wage, which itself was lower than the agent's reservation wage. Now, I also talked about the effect of a commodity tax on the supply, on the demand. We saw that it doesn't matter who gets taxed, the impact on the different surpluses will be the same. It all depends on the relative strength of elasticities. Now, another interesting question arises. It is the question of how much taxation is too much taxation. Obviously, if you do not tax the population, then the government will not generate any tax revenue. Now, what is it going to be if the government taxes 100%? Imagine that any hour that you worked is fully taxed, so you pretty much are working for free. You can easily imagine that people will not want to work. And this is what the Laffer Curve studies. It relates tax revenue to the tax rate. Arthur Laffer was a member of the Economic Policy Board under Ronald Reagan, former US president from 81 to 89. The idea is that increasing the tax rate increases tax revenue up to a certain point. And eventually, tax revenue will then start to decrease. Beyond a certain point, increasing the tax rate is counterproductive as the tax base might decrease due to individuals working less. The tax base is the amount of money on which the tax is going to apply. If the tax rate is too high, the tax base might decrease due to people deciding to work less, earning less income. The tax rate is so high, they might decide, well, it's not worth it. I'm going to take more leisure. They might also decide to report less income to pay less taxes. So overall, there's going to be a threshold. That's the idea of this curve. There's going to be a threshold above which tax revenue will overall decrease, because the tax rate might be very high, but if it applies to a lower and lower amount, at the end of the day, tax revenue might be smaller than if the taxes apply to a higher number of hours despite being smaller. This also means that there is a sweet spot, some sort of a tax rate that is going to maximize tax revenue. So, according to this theory, the curve should look like this inverted U-shape graph. On the x-axis, we have the tax rate in percentage terms, and on the y-axis, we have tax revenue. When the tax rate is equal to 0 and when it is equal to 100%, the curve assumes that there is absolutely no tax revenue being generated. It is pretty true when the tax rate is equal to 0, and well, we haven't experimented this yet, but it's pretty likely to be true as well when the tax rate is equal to 100%. Who would work 8 hours a day for free? So the left half of the graph shows that increasing the tax rate increases tax revenue. The right half shows a decreasing tax revenue after crossing the T-star threshold. So this suggests that there is a sweet spot that is going to maximize tax revenue, and the government should not tax any further or any lower. Now, of course, the main question for government is, where is it located? Where is the current tax rate located? We can imagine some sort of Laffer curve as well on different type of taxes: income tax versus labor tax versus commodity tax versus property tax, and so on. So it's all about knowing where the government is currently at and whether it should increase, decrease, or keep the tax rate where it is at. For many countries, the tax rate, this T-star rate, is estimated at around 50 to 60%. So an income tax rate beyond 60% starts to be counterproductive, because at such a tax rate, people decide to work less. And overall, a higher tax rate will apply on a lower tax base, on less income, and so overall there will be a lower tax revenue. Any questions about the Laffer curve? Okay. Now, I want to move on to characterizing tax systems. A tax system is said to be progressive if the average tax rate increases with income. And I will explain what I mean by average tax rate. It is said to be regressive if the average tax rate decreases with income. Finally, it is said to be neutral if the average tax rate does not change with income. So, governments can make a tax system progressive, regressive, or neutral in order to vary the incidence of tax between individuals. You can take a look at the following website. It shows the BC and the federal government tax rates and how they apply to different brackets of incomes. So, in particular, the concept of progressive, regressive, and neutral tax system will be relevant when we talk about income taxation. Income tax applies to income perceived in all its forms. In Canada, for the year 2019, income tax represents around 67%, 2/3 of the federal tax revenue. The average tax rate, which we use to tell whether a tax system is progressive, regressive, or neutral, is the total amount of tax paid divided by total income. So it is overall how much fraction of your income is being paid in the form of taxes. We need to distinguish the average tax rate from the marginal tax rate. The marginal tax rate is the percentage of tax applied to an extra dollar of income. And this marginal tax rate in general varies across income levels. If the tax rate is constant, then the system is neutral. Whether you make $50,000 or $100,000 or $1 billion, you still pay 20%, for instance, of your income. Constant, neutral. For income taxation, it is seldom the case. In general, income tax systems tend to be progressive, not necessarily, but they tend to be rather on the progressive side. And to achieve that, they propose multiple marginal tax rates. And so in this case, the average tax rate and the marginal tax rate will differ. Let's look at an example. Imagine, for instance, that the first $20,000 of income are taxed at 15%. The next $10,000 are taxed at 20%. And any income earned beyond $30,000 is taxed at 30%. So in this case, we have three different marginal tax rates based on which income range or income bracket you are located at. So let's compute the average tax rate. First, we need to compute the overall amount of taxes paid. So think about someone who is going to earn $50,000. He's going to pay 15% of taxes on the first $20,000. Then he's going to pay 20% of tax on the next $10,000. The next 10 means between 30,000 and 20,000. So 20% on these 10,000, and then 30% of tax on any income earned beyond $30,000. So since our individual earns $50,000, his income, the income that is taxed at 30%, will be equal to 50K minus 30K, which is $20,000. This is the total amount of income tax our individual is going to pay, and that equals $11,000. So the average tax rate is going to be $11,000 divided by $50,000, which equals 22%. 22% is the average tax rate. 15, 20, and 30 are different marginal tax rates that apply to different income brackets. Now, if you want to know whether this tax system is progressive, regressive, or neutral, you need to compare this average tax rate with another individual making more or less money. For instance, let's take somebody who makes an income of $25,000, so half as much as our first individual. Try to compute the amount of taxes he pays, compute the average tax rate, and compare with the $50,000 individual. Then you can tell whether the tax system is progressive, regressive, or neutral. Here, without even doing the math, we can guess already that the tax system that I presented here is progressive. Our individual making $25,000 will pay 15% on the first $20,000 and will pay 20% of tax on the next $5,000, which gets him to $25,000. So a $25,000 individual will pay a portion of his income at 15% and a portion of his income at 20%, which is lower than an individual making $50,000 who's paying 50% on some portion, 20% on another, and 30% on another. So when you see the marginal tax rate increase with the income levels, then you know that the tax system is progressive. Now, let me show you a quick overview of tax rates in Canada. There we go. So let's take a look at these tax rates. So the federal tax rates for 2021 is going to be 15% on the first $49,000, 20% on the next $49,000. So between $49,000 and $98,000, the individual pays 20% of tax. Then 26 on the next 53,000. So between 98 and 151,000, the individual will pay 26% of tax. Then 29, then 33. Past $216,511, the individual will pay 33% of tax on any extra dollar of income made. The website also proposes you a way to compute your federal tax. You can manually just input your taxable income from your return. You can apply all the different marginal tax rates, and then you can compute your final taxes. You also have provincial and territorial taxes for 2021. So they add up to the federal tax rates, but those ones are going to be collected by the province. So let's go back to British Columbia, for instance, where the first $42,000 are taxed at 5%. The next $42,000 are taxed at 7%, and so on. So if you add up this 5% for the first 42,000 and the first 15% here, you get that the first marginal tax rate for a British Columbia resident will be around 20%. You can find the same tax rates directly on the BC government website, and you can see the numbers are exactly the same. Now, let's go back to the taxation slides. And let's compare an income tax which is based on a percentage, which is an ad valorem tax, with a lump sum tax. A lump sum tax is a tax that is paid in dollar terms, and that is equal to the same amount regardless of your level of income. So if we talk about the lump sum tax, the taxpayer has to pay T dollars no matter the income level. Is this progressive, regressive, or neutral? Well, we can do the exact same computations with the previous two individuals. Imagine, for instance, that the lump sum tax equals $5,000. So an individual who earns $50,000 and pays $5,000 of taxes will then pay 10% of his income in the form of a tax. Somebody who makes $25,000 and also pays $5,000 worth of tax is then paying 20%, a fifth, of her income in the form of taxes. So, poor individuals, although they pay the exact same amount of money as richer individuals in this case, will pay a higher fraction of their income in the form of a tax. So, a lump sum tax system will be regressive. You might end up paying the same amount of tax as Jeff Bezos or Bill Gates, but for them, $5,000 represents a percent of a percent of a percent of a percent of their income, whereas for us, it might represent 5, 10, 20% of our income. Any questions? Okay, let's move on. Now I want to talk about two different tax credit programs. The first one is coming from the US, and the second one applies to Canada. The first one is called the Earned Income Tax Credit. It is an American refundable tax credit program for low to moderate income working households. So if you couple this program with the regular income tax program, it can increase progressivity of the income tax system by lowering the average tax rates of poorer households. The idea is that low income level households are refunded part of the taxes they pay. So they might be paying taxes, but because their income is low, they will get a refund from the government. This refund will decrease as income levels increase, so that somebody making a certain amount of money eventually will not get any refund from the government and will just pay taxes. Here's the AITC schedule for a parent filing singly with a child. There's a tax credit of 34 cents for each dollar earned for income up to $10,540. So it means that a tax credit will be equal to 0.34 times 10,540. That will be the total. That will be the total tax credit for that person. That represents around a third of $10,540. In fact, it is probably equal to $3,584, which are stable, which are staying at this level for any individual making between $10,540 and $19,330. So somebody making money in this range will get a fixed tax credit equal to this amount and will pay taxes according to the usual schedule. Once a person's income crosses this $19,330 threshold, the tax credit decreases by around 16 cents for each dollar earned over that amount. So there's still a tax credit, but it is pretty much half of what it was previously. Once the income level is beyond $41,765, the tax credit then is going to be 0. So this is a way to refund, to give some money back to the poor households. So it is a way to increase the progressivity of the income tax system in the US. Now, let me show you roughly how it looks like. You have a whole Wikipedia page on the EITC program. And this is the idea. This picture summarizes the EITC. We have different credit amounts according to the number of children, and they vary with income. So on the y-axis, you can find the credit amount. So all the way up to, up to those $19,000 around here. You can see that most of the credits which were stable between roughly $10,000 and $20,000 now are going to start decreasing. So the amount of money that you receive from the government starts pretty much decreasing, all the way until you get into the $40,000 to $50,000 range, depending on your marital status and the number of children you are taking care of. Okay, lastly, I want to talk about GST, HST tax credit. That applies in Canada. The GST, HST tax credit is a quarterly payment to help low and modest income families. GST and HST are paid in the same proportion by all, right? If you buy a coffee at Tim Hortons or Starbucks, whether it's you, me, Jeff Bezos, or Bill Gates, as long as it is in Canada, it is going to be subject to the same percentage, which can vary across provinces. But if Bill Gates buys a coffee in Vancouver, he will pay the same amount of taxes as myself. So in this sense, the GST HST tax system is regressive. The richer you are, the smaller fraction of your income GST HST taxes represent. Because of that, richer households consume a lower fraction of their income, and this is why refunds are being made throughout the year. The following website shows the kind of refunds you can obtain. And let me again get you to the web page. Which is here. The maximum amount for 2020 was $456 if you're single, and more if you're married and you have children. There is a calculation sheet online to see how much money you can get from GST and HST tax credits. The baseline is $299, to which you add either people you live with in common law or spouse and the number of children. Then to those $299 are added various amounts here, which are either $157 or 2% of line 7, which is the difference between your income and $9,686. So overall, the maximum amount that can be received by somebody is equal to $456 if the individual lives alone without any child. Now, imagine giving this money back to somebody who earns $25,000 and to somebody who earns $100,000. The amount of money received by both is going to be the same, but $456 will represent a higher fraction of income for a poorer household versus a richer household. So, let me summarize pretty much what we covered in this long lecture about taxation. First of all, we talked about why taxes are some sort of a necessary evil. Well, the government needs to get funds in order to provide public goods, infrastructures, school, roads, bridges, lighthouses, hospitals, natural parks, and so on. Pay also public sector employees, like public school teachers, public service workers, and so on. And also, the government can use tax revenue to fund redistribution. We saw that there can be sometimes different Pareto efficient allocations, They are all Pareto efficient in the sense that going away from it means making somebody worse off, at least one person worse off. And then the government can decide which allocation between two Pareto efficient allocations, which one is more preferable. In general, governments tend to prefer equity and fairness, so they operate redistribution to increase the income of poor households in order to reduce income inequalities. We learned how these income inequalities are measured using the Laffer curve and using the Gini coefficient. That was at the beginning of the lecture. The Gini coefficient is the area between the Laffer curve and the 45-degree line, a perfectly equal distribution. The bigger the Gini coefficient, the more unequal a distribution is, and that can be used to compare income distributions across countries, or maybe income distribution for the same country over time. See if inequalities have increased or decreased. In the tutorial, I talk about the use of equivalence scales as a way to compare households that differ across several characteristics. In particular, I talk about two characteristics: the structure of the household. How do you compare one person making $100,000 and living alone with a couple earning $200,000 overall, but with 2 or 3 children? Which one is the richest? Equivalence scales are estimated from data, and they're used to be able to compare these two types of households. For instance, if somebody lives alone, he doesn't need as much money as somebody who lives with a child to be as rich. So one person making $100,000 might be richer than a single parent making $100,000 because some of this money has to be used to raise the child. And the equivalence scale is a way to say that one single person making $100,000 is as rich as maybe one person with a child making $120,000, because a person with a child needs more money to be as rich, as wealthy as somebody without a child. The second characteristic that can be used to compare households is the cost of living scale. It is a way to compare households across locations. A household, like a couple, no child, making $100,000 is not as rich if it lives in Vancouver as if it lives in, let's say, Ottawa, or maybe in Northwest Territories, or maybe in the countryside in Saskatchewan. Because living in these places is cheaper than living in Toronto or Vancouver. These equivalence scales can be used to rank households more accurately in order to get a more accurate picture of the Laffer curve, the Gini coefficient, and overall the income distribution in a country. Then I talked about the different types of taxes that most of us encounter, starting with commodity taxes, which are present on every single item you purchase. We distinguish VAT taxes from sales tax. In general, VAT taxes are the ones that we are subject to. Income taxes are the ones that we pay as long as we earn some income. Poor households sometimes do not pay any taxes. For instance, students in British Columbia, if they have a part-time job on the side, probably barely pay any taxes. They can also use their tuition fees as credit in order to avoid paying taxes. Among income taxes, we distinguish personal income tax, the one I was talking about until now, and the corporate income tax, the tax that applies on firms' profits. Then, We talked about the payroll tax, a tax that applied directly to your wage, to your labor income. It is used in general to fund employment insurance, retirement pension plans, healthcare programs, and so on. Finally, the last one I talked about was property taxes, the one that is not likely to affect all of us. They apply to the value of an asset like a house or some land in general. Taxes come in two forms. Either they are ad valorem, they are expressed as a percentage because they are based on the value, on the price of the item or whatever amount they apply to. So GST, HST, and PST are ad valorem taxes. They're roughly equal to 19% overall in BC. So 19% of the price that you pay at Starbucks is corresponds to these taxes. Personal income tax is also ad valorem. It is a percentage of your income, right? We distinguish ad valorem taxes from per unit tax, or also called quantity tax. It is a specific duty based on the quantity of an item, not on the price. So for instance, there are some excise taxes on cannabis, alcohol, and tobacco. They are usually used for sin goods, addictive goods, gasoline as well, and they amount to a certain amount of money, like cents, per liter, per pound, or per unit of an item. The carbon tax, for instance, is roughly equal to 10 cents per liter in British Columbia. It's a bit different in Victoria, where there is also a city level carbon tax, but it's roughly equal to 10 cents. I believe it's between 9 and 11 according to the cities. There is also an excise tax on gasoline, tobacco, cannabis, and alcohol. I suggest you to take a look at it online. It's very interesting. Then I went to a model of a quantity tax because it makes the analysis simpler, but the intuition is the same as an ad valorem tax. It shifted the demand curve because we assumed the tax was imposed on the demand. There was a new equilibrium price that corresponded to a lower quantity, a higher price paid by consumers, but a lower price received by producers. The difference between the price paid and the price received is going to be the tax that the government is going to perceive, the yellow area. We saw that there is a deadweight loss associated to a tax. It is a loss of surplus that used to be allocated between consumers and producers. This tiny triangle here. Now, adding consumer, producer, and government surpluses, there is still a portion of surplus that doesn't go to anybody. Following this model, I talked about who is more affected by a tax. This is what we call tax incidence. After all, here we impose the tax on consumers, but the price did not simply increase by an amount T. It did not become P star plus T. Instead, the sale price became P prime, on top of which we added the tax. So you can see that here, the tax is not fully absorbed by consumers, although it is paid by them. It is also partly absorbed by producers because the new equilibrium price ended up being lower than the initial one. We saw that this tax burden is all about elasticities. It's all about which side of the market is more or less elastic. Here I took the example of a demand which is more inelastic than the supply, and a tax in this case will have a bigger incidence on consumers than on producers. Here you can see that the difference in the price paid by consumer before and after, they are paying P prime plus T after tax, and they used to pay P star before. This difference is higher than the difference in the price received by firms. For firms, the price received has not decreased a lot. It has decreased, but not a lot. And you can see that in the deadweight loss, there is a larger portion of it that used to be allocated to consumers. Because consumers have a more inelastic demand, they are less sensitive to a change in price, so the new equilibrium price will end up being high for them because it doesn't lead to a big decrease in the quantity sold. In tutorials, I take the case of a tax on the supply by keeping the demand exactly as inelastic, and in the tutorial we can see that the different surpluses are exactly the same. So at the end of the day, whether you tax consumers or producers doesn't matter. It depends on who is more elastic. Then I talked about the effect of labor tax, and that's how I started the lecture today. I talked about two different effects. On one hand, leisure seems more appealing now because working doesn't yield as much money as before. On the other hand, because of the tax rate, individuals are poorer, so they might decide to work more. Overall, they will consume less because their budget set is now reduced. The net effect on labor supply is ambiguous. It all depends on the personal preferences of the individual. If the individual has a very strong taste for leisure, then a labor tax will imply a decrease in work hours and an increase in leisure. But if the individual has a very high preference for consumption versus leisure, then the individual will not hesitate having less leisure to work more so that he can afford still some high level of consumption. Then we talked about how much taxation is too much taxation. And that's what the Laffer curve is trying to answer. Simple concept, yet pretty powerful. Now, it is all about knowing where a government or a public authority is located in terms of tax rate. Finally, I talked about the tax systems as being either progressive, regressive, or neutral. And I mentioned that progressivity can be a tool to increase more, to decrease income inequalities by taking more money from the rich and less money from the poor, and then operate redistribution. In particular, we talk about progressive, regressive, and neutral tax systems when it comes to income taxation. We also talk about it for other taxes, but in particular for income taxation, where we define different marginal rates depending on where one's income is located at, so that the average tax rate overall is going to differ across income levels. For most Western countries, most developed countries, and developing countries too, I believe, the income tax system tends to be progressive. So it tends to have higher average tax rates for richer households than for poorer households. On top of such income tax systems, there can be other programs that aim at maybe making the system more or less progressive, such as the Earned Income Tax Credit, which aims at helping poor households by refunding, by giving them a tax credit up to a certain amount of income. And then I talked about the GST HST tax credit, which is a refund to help low and modest income families. In my case, I am eligible to the maximum amount, $451 or $456, I believe. That was the 2020 numbers. And I actually received my first GST HST check a couple of days ago that amounted to $157.50. I will get 3 more checks during the year, and the amounts will add up to $451 or $56. That's it for this lecture on taxation. Have a good rest of your week and see you in the next one. Bye.